In the macro, what I see here is it's August. And yeah, we're seeing the little flows in markets. But to me, this is really going to accelerate into what I view as one of the biggest resets of our lifetimes. China in decline. That's way overdue and normal. I look at commodities right now. Crude oil's just had its bounce and it should go lower. That's normal. Copper's starting to tilt back down. And the number one factor is the stock market has to stay up or else everything trickles down. Housing, yields, interest rates. And still, the problem is that in my lifetime, I've never really seen is even if it drops at say 10% from here, which is not supposed to matter, the Fed is still not going to ease. They might start pricing for it because the metrics they watch, personal consumption, expenditures, employment cost indexes, will stay sticky. But some of the key things I liked, like PPI, just dropped at its fastest pace in history, and it's starting to bounce a little bit.
There may be few comparable periods in history when virtually all risk assets were as dependent on the stock market remaining elevated as now. Never before seen extremes and datasets going back 50-plus years may draw guidance from the basics of economics and human nature. Senior commodity strategist for Bloomberg Intelligence, Mike McGlone, posted on his Twitter. In another tweet, McGlone posted that some normalization of relative risk asset levels may be a primary outcome of the diligent Fed. That rate hike expectations have been a primary boat buoyed by the rising stock market in 2023 could tweak the rules of never forgetting where you came from in terms of markets. U.S. stocks dipped early Monday after the Nasdaq Composite recorded its first back-to-back losing weeks of the year. Meanwhile, Asian markets declined Monday and shares of Chinese property giant Country Garden hit a record low after it announced the suspension of bond trading amid its cash crunch. Stocks have slumped in the closing month of summer, and investors will be watching for a rebound later this week as earnings from Target, Home Depot, and Walmart roll out. Retail sales data for July will come out Tuesday. In this video, McGlone talks about the massive sellouts, inflation, and negative money supply, and also added how assets like Bitcoin can be referred to as a stable coin. As you go into this Alpha Pack video, don't forget to like, subscribe, and drop your comments below.
US, okay, Neutrino, you get around 5%. In China, you're getting 2%. Well, good luck with that one. Not much happening there. In Japan, you get nothing, maybe a couple basis points. In Germany, the third largest economy, you get 3%. You're still getting 200 basis points more in the US. And in England, you get about the same. What's the safest asset in the planet? It's still US Treasuries. You're going to get those dollars back. And then, of course, you have 11 aircraft carrier battle groups protecting you. So I look at this as that environment about debt. Heard it, seen it, and I just lived with it from 30, 40 years ago when I was trading U.S. Treasuries. It's just so mute. We're all turning Japanese. But that's, to me, the credit event will come and almost never don't. They always happen. You have to have risk assets go down, and they've gone up. So you take out the tide a little bit, and then you see who's not wearing clothes. And to me, that's where we're heading. And that's the key question I ask is what stops this? So what we're doing now is the greatest rug pull in liquidity ever after the biggest pump in liquidity ever. And the fact that I can say that and show the data is still shocking to me. I can go back and give you examples from the 1920s when the U.S. created massive supply of liquidity and they shouldn't have. So money supply is still negative. PPI year over year is still negative, and the Fed is still hiking rates and price for that. So I look at it as everything else is going to trickle down from that, and the Fed's not going to stop. They will. I fully expect yields, bond yields, everything to drop after the stock market does, and the question is what stops it. It's all trickling there. So we on our call this morning, even our main economists said, yes, they've been early, they've been a little bit wrong, but they're still maintaining the year-end recession view. So let's picture ourselves in December. Recession's kicking in. People are hoping the Fed will ease, and they'll probably get up and say, no, we're not, because we still see high inflation. That's something we haven't seen in a while. That's the great reset, I think, happening in early days. And then you tilt over to what should be early indications of that. What was the biggest liquidity pump indicator, new technology ever for the last 10 years? Cryptos. The best indication should be Bitcoin, and that's where I'm looking for the lead indication from Bitcoin, and it's still kind of showing what I expected. It got up to near 30. And it's just not been able to get much above there. At some point, Dave was going to go. At some point, that's going to change. I know Bitcoin has become a stable coin, and stable coins are clearly globally becoming crypto dollars. And that's what I loved writing about that when Fitch downgraded U.S. debt. If you use the S&P when they downgraded U.S. debt in 2011, that was a great time to buy the dollar. The trade-weighted dollar index is up 40% since then. Every asset in the U.S. on a trade-weighted basis is up 40% versus every other asset in the planet since that downgrade. So I look at it as thank you for pointing out the obvious. Thank you for pointing out how strong we are, because we're debating in this and facing this. You can't do that in China, in Russia.
The US dollar hit a more than 1-month high on Monday as a haven for investors wary of China's economy and other global turmoil, and Wall Street swung higher ahead of fresh data on consumer appetite. The dollar index, which tracks the greenback versus a basket of 6 currencies, was last up 0.19% at 103.04 after hitting its highest level since July 7. The dollar surged on news that China's new bank loans tumbled in July even as policymakers cut interest rates. Investors also feared that trouble at the nation's largest private property developer, Country Garden, 2007, HK, could have a chilling effect on home buyers and financial institutions. Let us hear what Mike McGlone has to say about the equity markets and the Chinese property.
The key thing we need to look forward to is, unfortunately, is there's plenty of times in history money just leaves the system and you just poof, it goes away. And that's what I think is going to happen in the equity market. Remember, we've had this, it's really been since the low in 2009. But what's changed, the key thing is also is that's helped boost the equity market to highest levels ever versus housing, versus GDP, versus sales, you name it. And versus the rest of the world, the U.S. stock market. That to me is where it's the train wreck I see happening is the Fed's not going to be there to save the equity market. And right now, it's doing the equity investors a favor, particularly people who are retired in Florida. Turn off CNBC, stop trading stocks. I mean, it's the biggest casino in the world, and just put your assets into these treasuries that the government has pumped up to these high yields. When you get to that deflationary trajectory, I didn't say if, because it always has happened that way. You get deflation after these type of events and this type of action, and particularly now we're in an environment where we're in the most, in terms of technology pushing prices down, one of the most deflationary environments ever. Book of Price Tomorrow by Jeff Booth, Super Abundance, another book I've read. They're all tilting that way. To me, that's what's going to happen. Is the Fed's not going to save you the first move, that first 20%, 50% down, and then it gets over to potential depressionary levels. That's what I'm afraid of. The key thing is right now, that's the current trajectory. We've had the bounce. We know the Fed's not going to save us. The market's still living this hopium, which is not my word. I stole from someone else, I think, on your program, but I appreciate
the classic crypto term. Yeah.
So thanks for the mention, David. It's a classic crypto, but it's great. I love mentioning that with people. Like you mentioned boomer rocks to people in gold conference. They had no idea. I'm like, you didn't know what a boomer rock was? Okay, but back to the key things. That's the scenario I think we're going to. That's my base case. It's been my base case for over a year. I know it's early, it's been wrong, but it's tilting that way. I can show you it's happening in commodities, it's happening in inverted curve, leading into economic indicators, still at -8%. You look at the potential for recession from the New York Fed's probability recession from a yield curve. It's the highest since 1982. Great, maybe that stuff doesn't matter. But then you have to put this in the context of rational human nature and economics and history. What we've done is distorted all the models. And now we're going back to normalization. And I think we're going back to that world where bad news is going to be bad news and good news is going to be good news. It's going to take a while for that transition. Potential iteration, I completely agree. Remember, we have good example for what's happening. We're all turning Japanese. Now we kind of got away from that short term, but we're all going back there. But I have to, just one thing I did appreciate a column that was written by my colleague Niall Ferguson this week. An economy is not a plane, it won't land gently. And I just wanted to use that because people use that landing analogy. I love it, but this is why I think I agree with you, but that's what's happening. We're going to, I think it's just a matter of time we get a reset in risk assets that have gone up and created an exceptional amount of wealth and inflation, and then the Fed will save us, but not in the pace they have. The point is, we're not there yet. We're still in that point. We need to see that happen. And that's why I look at it. That's why I say, just there's certain times in life you're supposed to say, thank you, U.S. government, too, and good luck to people invest overweight the stock market.
Federal Reserve officials meet next month to determine whether to raise interest rates for the 12th time to cool the economy or hold them steady. Some officials think the Fed has already raised its benchmark lending rate enough to curb inflation, but others think it's too soon to tap the brakes. The central bank has become divided, but right now financial markets see more than a 90% chance the central bank will agree to pause rate hikes next month, according to the CME Fed Watch tool. We saw the beginning of the division within the Fed in the minutes for the June meeting. Rajiv Sharma, managing director of fixed income at Key Private Bank, told CNN some Fed members were opposed to the pause and wanted to go full steam ahead, but they came around knowing that there would probably be a hike in July. Indeed, Fed officials unanimously voted to increase rates by a quarter point to a range of 5.25 to 5.5%, the highest level in 22 years. and Fed Chair Jerome Powell maintained a hawkish tone on fighting inflation in his post-meeting news conference, making it clear that another increase is still in the cards. His remarks at an annual economics symposium in Jackson Hole, Wyoming, later this month will set the narrative straight and may give a hint about the Fed's upcoming September decision. Philadelphia Fed President Patrick Harker echoed that sentiment in a speech last week, saying, "I believe we may be at the point where we can be patient and hold rates steady. We are today in a restrictive stance, and as inflation continues to fall, the degree to which it's restrictive grows as that gap between the inflation rate and our interest rate widens," Atlanta Fed President Ralph Bostic said recently. "So I think that will put enough constraint on the economy that it will continue to slow." What do you think can be done regarding this? Let me know your thoughts in the comment section below. Also, don't forget to like this video, subscribe, and turn on notifications. Thanks for watching.